Good morning, publickers. I'm Sarah Evans, founder of Sevens PR. It's always important for me to acknowledge that I am not an investing expert, but a passionate and voracious learner with a focus in the tech industry. Let's jump right in today. We are focusing on Chinese technology trends. Optimism for tech companies in the country has been trending higher as signs point to an easing of regulations across several industries. A major report this week said regulators will soon end a probe into DD Global and allow the ride-sharing company to sign up new users. There was also some positive news in the gaming industry. With us to dig into the state of technology in China is Shehzad Qazi, Managing Director of China Beige Book. Thanks so much for joining us today.
Hi, Sarah. Great to be with you all.
Thank you. Can you start off by providing some context into the news we've been getting out of China and why there seems to be an improvement in sentiment for Chinese technology?
Yeah, Sarah, I think what you're looking at right now is the reality that markets are just incredibly desperate for positive news. And they're incredibly desperate, especially for positive news out of China. So to the extent that there is some positive signaling in the press, I think over the last few weeks, couple of weeks, investors just really clung on to hopes of the tech crackdown that we saw take place in China over the last couple of years is perhaps easing up. Some have even gone as far as expressing that it's ended and it's behind us. The reality is that none of that is actually true. There's no concrete evidence of the fact that the tech crackdown is over. To the extent that there's some leaks in the press about the anti-IPO happening, as you probably and others here already saw, the Chinese regulator, their equivalent of the SEC, already came out and said that, look, we're not working on anything at the moment. So I think a lot of this is falling for the positive messaging coming out of Beijing, out of, quite frankly, sheer desperation.
Thanks for that insight. Several investment managers in the U.S. have called Chinese stocks uninvestable. Do you think it's too soon to tell if we've hit a bottom with Chinese tech stocks and if the environment for growth companies is really improving?
Yeah, that's the second element of it. Unfortunately, as somebody who's been tracking China for 10 years, one of the things that I'm most frustrated by is the black and white view that you get on China. So either, you have your super bears or you have your super bulls, and there's a lack of nuance. I wouldn't say that the Chinese tech stocks or Chinese stocks in general are uninvestable. I think what we need to do is, try to focus more on understanding what the ground realities are, what the data are telling us, and then intelligently produce a investment strategy geared towards, maximizing your gains. So that tends to be lacking a lot. Now, the economic environment in China is very bleak. We're looking at some of the worst numbers in our China Beige Book survey. So we survey over 4,000 companies in any given quarter, thousands and thousands of firms in any given month. In April of this year, we saw hands down the worst economic numbers coming out of China since the initial COVID recession in early 2020. In May, you saw the pain continue, and certain important parts of the economy, like Shanghai and services and so forth, actually saw additional weakness. Now, my expectation is that the June numbers are going to be better, but I think we can say with a lot of confidence that the second quarter is going to see a pretty serious slowdown in China. I'm also not particularly positive that the second half in reality will be this, blowout a period of growth. So I think a lot of economic uncertainty is ahead of us, but it's about smartly tracking it and understanding it so we can figure out what the right opportunities are.
I really love that you bring up that point because so often, especially with investing overall, it is a gray area. So it's important to learn from folks like you who are hyper-focused on different areas. What has been the incentive for regulators to be so strict?
So I think, you're looking at an environment, first of all, in China where much of these companies, they had monopoly power. They could do essentially whatever they pleased. It was a bit of a free-for-all situation because regulation was either non-existent or incredibly lax. Some of it has been the need to correct that, from a standpoint of consumer protection and so forth. But of course, you're looking at a one-party system where you've had some of these tech behemoths and and their owners and founders, people like Jack Ma, who've become not only incredibly wealthy, but have then decided to take their influence on the political side of the equation, openly criticizing the government, openly criticizing the financial regulators, which were trying to regulate their P2P lending businesses and so forth. And as we know, in China, there is room to make money so long as you are not being very, very vocal about your dissent against a party or its rules and regulation. But the moment you step into the political sphere, well, then you become a very clear target. To an extent, when it comes to the tech crackdown, I think some of this has, outside of some of the necessary steps that were needed to regulate the tech companies out there, and some of their practices, some of it is also really, quite frankly, just political targeting.
Yeah, it's an important point to make. Let's look at some other industries, maybe those that seem better positioned for a rebound than others when you take the politics out of it. Looking at fintech, gaming, e-commerce, what else is on the radar?
Yeah, that's a tough one, right? Because again, when you're looking at a period of overall slowdown, what I would say is that I think we have to be very, very careful about how we approach anything having to do with consumption, because Chinese households remain very, very cautious about, and are holding their pocketbooks tightly in their hands, just because of first of all, the amount of uncertainty that is out there, but also because when slowdowns are taking place, they're not able to take advantage of things the way when lockdowns are taking place, they're not able to just quickly transition and say, look, we'll spend our money on buying things because guess what? You can place an order, but it may not get delivered because of the logistics lockdown that is taking place, along with you not being able to leave your household. So I think it is going to be a tough market to pick winners in for the foreseeable future. If you are to believe that COVID hangs as a major risk and lockdowns therefore hang as a major risk, which means that there's no clear growth driver. I think to the extent you get some amounts of infrastructure development that gets pushed through over the late summer, early fall period, that could be somewhat positive for certain commodities and construction materials and so forth. So maybe focus on that a little bit while realizing that that's not going to last forever, nor is it going to be as big and as bad as it used to be, in the aftermath of the great financial crisis or so forth.
Thanks for that insight. Let's zoom out a bit. Tech stocks here in the U.S. have been crushed by rising rates. What are the macro trends in China that are having the biggest impact on businesses?
The biggest thing is the zero COVID policy. Now, the zero COVID policy today is a lot more flexible and a lot more targeted than it used to be in 2020 or even 2021. That's a positive sign. Investors need to make sure they're accounting for that. But still, when you lock down entire neighborhoods and compounds and now districts, that will inevitably slow down consumption, as I mentioned. But as we've now learned, even under the current factory the so-called bubble factory production process that they've come up with, where certain workers are able to stay and live on site and continue producing and so forth, manufacturing activity also is getting a hit. Right? And of course, port lockdowns add on to that overall slowdown because if people's orders are not finished and delivered on time, their incentive to place more orders with the factory naturally are going to be lower. So I think COVID and its impact on the broader economy is really the thing to be keenly watching. I don't think it's going away anywhere. If anything, if you listen to what President Xi just said 2 days ago, he wants unwavering support for China's ongoing zero COVID approach. So till the time you get the introduction of mRNA vaccines or other imported, products that can help fight back COVID, zero COVID is here to stay. And I think that's a key risk investors need to be watching for and accounting for.
Shehzad Qazi, thank you so much for joining us today. We really did get to dig into the state of tech in China. Where can people find you online or get additional resources from you ongoing?
The first thing I'd say is follow us on Twitter. Our handle is @ChinaBeigeBook.com. Our website is www.ChinaBeigeBook.com. My own Twitter is Shehzad H. Qazi. We are pretty active. Sometimes we're provocative and humorous, so I don't think you'll be bored. So give us a follow.
That always sounds good to me. Well, thank you so much for joining us. And to all of you listening, please have a safe, happy, healthy weekend. And we'll see you back next week, same times, same space for Tech Check.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.